Normally when you look at a thermometer and it says 72 degrees, you assume it's like a beautiful, comfortable day outside.
Right, yeah.
You don't assume that half your house is engulfed in flames, the other half is some kind of frozen wasteland, and the thermostat is just, happily averaging it all out to 72.
It's a statistical illusion of comfort.
Exactly.
I mean, people love a clean, aggregated average, but it almost always masks a tremendous amount of chaos beneath the surface.
Yeah, and that illusion is really the perfect lens for looking at the stock market this weekend, because it's Sunday, August 23rd, 2026. And if you just glance at the headline numbers, I mean, the S&P 500 closed the week hovering right near an all-time high.
Yeah, 6,142.
Right, 6,142.10 to be exact. And the NASDAQ is soaring, the Dow is up, and the volatility index, the VIX, it's sitting down near 12.
Which is incredibly low.
It is. It usually signals total market complacency. Like on paper, the global economy is throwing this massive party. But we have our hands on the latest bulls, bears, and the Bell Market Intelligence Report.
Yeah.
And our mission for this deep dive is to basically decode these mixed signals.
Yeah, because what's wild is how the report exposes the absolute fracture hiding underneath those record highs.
Oh, completely. We are looking at a deeply bifurcated consumer base, intense anxiety over corporate spending, and a looming geopolitical trap in the energy sector that could just completely upend the Federal Reserve's whole strategy.
Yeah, it's a lot.
It is.
Yeah.
So we're going to figure out how to navigate what is shaping up to be an incredibly volatile week ahead.
Well, to really grasp the tension in this report, I think we have to start by looking at the tectonic shift that just occurred at the Jackson Hole Symposium.
Right, the Fed meeting.
Exactly. The fundamental narrative governing the global economy for the past several years has been this relentless war on inflation.
Yeah.
And Jerome Powell's speech on Friday essentially marked the end of that specific war. Yeah, he signaled that the last mile of inflation has basically been conquered. So they're shifting the central bank's entire focus toward managing a very delicate glide path for the economy.
Okay, let's unpack this. Because the tone coming out of Jackson Hole, it wasn't exactly a victory lap with confetti, right?
Yeah.
It felt much more cautious.
It was. And the caution stems from the Federal Reserve's GOOL mandate.
Right.
By law, they are required to do two things: keep prices stable and maximize employment.
Just those two.
Just those two. And for years, they've been, hammering the demand side of the economy with high interest rates to bring prices down. Now, core PCE, the personal consumption expenditures.
This is the one that strips out the volatile food and energy prices.
Exactly. It's the Fed's preferred inflation metric.
Yeah.
So that is currently sitting at 2.4%.
Okay.
It's not the mythical 2.8% target, but the consensus is that it's close enough. The problem is that while they were so hyper-focused on prices, the other side of their mandate, the labor market, it started to fracture. The intelligence report highlights what it calls visible cracks in the employment data.
Meaning the cost of crushing inflation was that companies just stopped hiring and unemployment is starting to pick up.
Yes. But the most crucial detail here is that wage growth is distinctly decelerating.
Which sounds bad.
To the average person listening, slower wage growth sounds like objectively terrible news.
Mm-hmm.
I mean, your paycheck isn't growing as fast as it used to. But to a central banker, it is the ultimate green light.
Really?
Yeah, because it means the dreaded wage price spiral is no longer a systemic threat to the economy.
Okay, so to clarify that spiral, that's the vicious cycle where everyday prices go up, so workers demand higher pay to afford their groceries, which then forces companies to raise their prices again just to cover their newly inflated payroll costs.
Exactly.
It becomes this infinite loop of inflation.
And that feedback loop is what terrifies economists the most. Because once it takes hold, it is incredibly difficult to break without causing a severe recession. So by seeing wage growth finally decelerate, the Fed has the empirical data to say, okay, the spiral is broken. And that realization is causing the market to reprice its expectations aggressively.
So what are the expectations now?
Well, if you look at the CME FedWatch tool, which essentially monitors where institutional money is placing its bets on monetary policy, it is now pricing in a 72% probability of a 25 basis point rate cut this coming September.
Okay.
That would drop the Fed's target range down to 4.25 to 4.50%.
Okay, so if the American economy is a car, the Fed has been standing on the brakes for years with these restrictive high interest rates.
Right.
Now, they aren't exactly slamming on the gas pedal to accelerate, but they are finally taking their foot off the brake to let the car coast.
Yeah.
And the intelligence report mentions a a terminal rate of 3.5%. So I assume 3.5% is the cruising speed they want to coast at.
The car analogy illustrates the mechanism perfectly. Because the stock market isn't reacting to where the car is right now, it's reacting to where the car is going to coast to.
Ah, I see.
A terminal rate of 3.5% is considered the neutral monetary stance for our current environment. It is an interest rate that neither restricts economic growth nor artificially stimulates it.
Okay, that makes sense.
And if we connect this to the bigger picture, anticipating that glide down to 3.5% is exactly why the 10-year Treasury yield dropped 8 basis points this week to settle at 3.62%. Bond investors are just rushing to lock in those higher yields today, knowing the Fed is about to take its foot off the brake.
But a shifting macro environment like this, transitioning into this coast mode, it always creates winners and losers on the ground.
Absolutely.
Which leads directly to the two economies concept that was outlined in the report. Because I look at this market optimism, and I see a massive contradiction.
What do you mean?
Well, earlier in the week, we saw quarterly earnings from Walmart and Target.
Oh, right.
And the data in those reports showed unequivocally that the lower income bracket is actively being squeezed. I mean, they are tapped out. They're feeling the cumulative pain of the last few years of compounding inflation. So if the average consumer is genuinely struggling to buy basic household goods, how did the NASDAQ jump 1.8% to close over 20,800?
Yeah.
It just feels completely detached from reality.
Well, the detachment you were feeling is a well-documented economic phenomenon known as the wealth effect.
The wealth effect.
Yeah, the economy is essentially operating on two completely different tracks right now. You have the stock market hovering at all-time highs, and housing prices remain historically elevated.
Right.
So the demographic that owns those assets, which is typically the middle to upper income brackets, they're watching their net worth grow significantly on paper.
Just massive unrealized gains.
Exactly. And that feeling of abstract wealth sustains their high-end discretionary spending. They feel rich, so they continue booking vacations, eating out, and buying luxury goods.
Which artificially inflates the aggregate economic data. Like, if you just look at total retail sales, it looks like the consumer's doing fine.
Right.
But that average is masking the fact that the top 20% is doing all the heavy lifting, while the bottom 50% is just drowning.
That is the statistical illusion we talked about at the very beginning. The overall consumer data remains resilient strictly because of asset inflation at the top.
Wow.
Meanwhile, those lower-income shoppers who don't have stock portfolios or home equity to buffer them, they're pulling back sharply on discretionary spending just to afford groceries.
Yeah.
And that bifurcated reality is exactly what the Walmart and Target earnings exposed.
But the wealth effect alone isn't powerful enough to drive the NASDAQ into the stratosphere, right?
Yeah.
The intelligence report makes it very clear that the real structural driver holding this market up is the AI monetization wave.
Yes. And this is a vital evolution in the tech sector, because over the last 18 months, the primary anxiety haunting Wall Street was AI over expenditure.
People were panicking about the cost.
Huge panic. We saw mega cap tech companies spending tens of billions of dollars hoarding AI chips. And the fear was that this was a speculative, build it and they will come bubble.
Right.
Investors were terrified that these companies were building massive infrastructure without a clear path to actually generating revenue from it.
Like they were afraid nobody was going to show up to the party. They just spent billions to throw.
Exactly. But the data dropping this week fundamentally dismantled that bearish argument.
Because it's actually working.
It is. The intelligence report zeroes in on late-week rallies from Microsoft and NVDA. NVIDIA, notably, is holding incredibly strong support above the 20,000 pre-split level.
That's huge.
It is. And the catalyst for this sustained rally wasn't just more hype about future potential. It was hard empirical data from Tier 2 data center providers.
Okay, let's define Tier 2 providers for a second. We aren't talking about the mega cloud behemoths like Amazon AWS or Google Cloud, right?
No.
We're talking about specialized, slightly smaller operators.
Right. These Tier 2 operators are essentially the canary in the coal mine for actual AI adoption. They rent out server space and compute power to smaller enterprises and startups.
Okay.
And these providers reported record-high utilization rates for NVIDIA's Blackwell 2 chips.
Utilization rates.
Yes. Utilization rate is the metric that proves the business model. It means these wildly expensive chips aren't just sitting in a warehouse gathering dust.
Right.
And they aren't just being used for internal research and development. They're plugged in, they're turned on, and paying clients are actively running models on them at maximum capacity.
Wow. So the revenue is actually materializing.
Exactly.
So the tech sector is surging because AI is finally paying the bills, and the broader market is rallying because September rate cuts are basically priced in.
Yep.
We are sitting in this pristine Goldilocks scenario, not too hot, not too cold.
Hmm.
But bringing it back to our coasting car analogy, the Fed had their foot hovering over the brake, ready to coast. What happens if someone suddenly spikes the price of gas? Like, what is the structural threat to this perfect setup?
Well, the threat is highly specific, and it's geopolitical. It's energy volatility.
Energy.
The intelligence report outlines this as the ultimate bear case for the current market. Crude oil, specifically the WTI benchmark, just surged 3% to $84.20 per barrel.
And the trigger for that surge was renewed supply chain bottlenecks in the Strait of Hormuz.
Yes.
For a quick geographical refresher for anyone listening, that is the incredibly narrow waterway between the Persian Gulf and the Gulf of Oman. A staggering percentage of the world's daily oil supply has to flow through that single choke point.
It's massive. And any disruption in the Strait of Hormuz immediately impacts global supply.
Right.
In the very short term, this bottleneck created a tactical tailwind for the energy sector. We saw significant, unusual options activity late Friday, with heavy call buying on giants like ExxonMobil and Chevron.
Because they profit off the squeeze.
Right. As the underlying commodity price goes up, those companies generate massive cash flow.
But what is good for Exxon is absolutely toxic for the Federal Reserve.
No, completely.
Because if crude oil spikes, the cost of diesel spikes. The cost of shipping goods across the country spikes. The cost of manufacturing plastic spikes. That energy cost bleeds into the price of literally everything on a store shelf.
Yep.
Doesn't that mean inflation comes roaring back right at the exact moment the Fed is trying to declare victory and cut rates?
That mechanism is the trap. The report explicitly highlights $95 per barrel as the danger zone.
$95.
If crude oil hits $95, it reignites those broad-based inflation fears. The Fed would be staring at imported inflation driven by a supply shock they have zero control over.
Right, because they can't print oil.
Exactly. If the data shows inflation creeping back up, central bankers might be forced to hold rates steady in September instead of delivering that cut.
And because the market is pricing in a 72% probability of a rate cut, it is pricing in a 0% probability of a pause caused by an oil shock.
Zero.
If the Fed suddenly announces, sorry, energy prices are too high, we have to hold rates where they are, the market would violently reprice.
It would be a systemic shock. It would completely incinerate the glide path narrative. Companies that rely on cheaper borrowing costs to survive would be decimated.
Wow.
This is why the energy sector is the linchpin holding the entire macroeconomic picture together right now.
Because this glide path is so incredibly fragile and so entirely reliant on energy prices staying put, it means the market is going to aggressively overreact to every single data point dropping this week.
Oh, definitely.
We're heading into week 35, the final full week of August. Historically, this is a very low-volume week on Wall Street. People are squeezing in their last summer vacations. Trading desks are half empty.
Yeah.
But low volume often equals high volatility because there are fewer active buyers and sellers to absorb the shock if a surprising piece of data drops.
And the intelligence report frames the upcoming week around three distinct anxieties the market is facing.
Okay, what are they?
The first is housing gridlock.
Okay.
The second is corporate resilience.
Right.
And the final and most dangerous theme is the inflation tripwire.
Okay, let's walk through those themes. Tuesday, August 25th, we hit the first anxiety with the S&P Case-Shiller Home Price Index. The consensus expectation is a 4.2% year-over-year increase. But the report warns we need to look past the price tag and watch for a housing freeze.
A housing freeze?
Yeah. And if we look at the psychology of the average home buyer right now, it makes perfect sense. I mean, if you were looking to buy a house and every financial headline is screaming that the Federal Reserve is going to cut interest rates next month, you are going to sit on your hands.
You're going to wait.
You will stubbornly wait to lock in a mortgage until those rates officially drop.
It is entirely rational behavior for an individual. I mean, why commit to a 30-year mortgage at today's restrictive rates when, cheaper capital is just weeks away?
Right.
The problem arises when millions of individuals make that rational choice simultaneously. The housing market transaction volume just plummets.
Into tanks.
Sellers won't lower prices because they know buyers are just waiting for the rate cut, and buyers won't buy until the cut happens. The entire real estate sector essentially paralyzes itself in anticipation.
Wow. Moving to the second theme, corporate resilience. Thursday, August 27th is a massive day. We get the second estimate for Q2 2026 GDP, with consensus sitting at 2.1%.
And that 2.1% number requires heavy scrutiny.
Why is that?
The report notes that if the GDP print comes in below 1.8%, it will immediately trigger recession watch alarms across trading desks.
Really? So just a few tenths of a percent makes that big a difference?
Yes, because the market desperately wants the economy to slow down just enough to starve inflation, but not so much that growth stalls out entirely. A GDP reading below 1.8% suggests the Fed kept their foot on the brake for too long and the car is grinding to a halt.
Man. On that same day, Thursday, we also get corporate earnings that will serve as litmus tests for specific sectors. Salesforce reports after hours, which the report flags as the primary indicator for enterprise software spending.
Yeah.
Analysts are specifically looking for conversion metrics on their Agentforce AI tools. It's the ultimate test of whether everyday companies are actually integrating AI into their daily workflow or if it's still just a novelty.
Right.
Then we have CrowdStrike.
Which is fascinating because CrowdStrike serves as the microscope for corporate IT and cybersecurity budgets.
Right.
Institutional investors have a very rigid hurdle in mind here. They want to see 25% or higher annual recurring revenue growth. ARR, exactly. It's the holy grail metric for software as a service companies. It represents predictable, locked-in subscription income, which is the foundation of their massive valuations.
Right.
If CrowdStrike manages to clear that 25% hurdle, it sends a powerful signal that corporations are still heavily prioritizing and funding their cybersecurity infrastructure, completely ignoring any broader macroeconomic anxieties.
And wrapping up Thursday, we get Lululemon. This earnings call will be the stress test for the well effect we broke down earlier.
Oh, absolutely.
If the Walmart shopper is actively pulling back on basic groceries, but the Lululemon shopper is still happily dropping $120 on yoga pants without blinking, the two-economy theory is validated.
It is. Now, the final theme, the inflation tripwire, arrives on Friday, August 28th. We get the Personal Income and Outlays Report, which contains the PCE deflator.
Which, as we established, is the Fed's absolute favorite inflation metric.
What's fascinating here is that this single data point essentially holds the fate of the entire September rate cut.
Just this one number.
Just this one number. The market is fully positioned for a cool, stabilizing number. If we see any upside surprise whatsoever, I mean, even a fraction of a percent higher than expected, it will instantly assassinate the September rally.
Wow.
The narrative will violently snap back from a gentle glide path to a restrictive higher-for-longer environment, and the sell-off in equities would be immediate.
The report also flags Friday for institutional rebalancing, specifically watching the VanEck semiconductor ETF, the SMH.
Right, because end-of-month rebalancing is a mechanical process. Massive passive index funds have to adjust their holdings to match target weightings.
So it's not even about human emotion, it's just a formula.
Exactly, it's just a formula. If a sector like semiconductors has run up massively in price, these funds are forced to systematically sell some of those winners and buy underperforming sectors to get their portfolios back to their mandated ratios.
Okay, I see.
The SMH ETF acts as the proxy for the entire AI infrastructure narrative. So if NVIDIA and the broader semiconductor space can absorb that forced mechanical selling and hold their ground, the report suggests tech is poised for a major upward surge in September.
So synthesizing all this intelligence, how is the smart money actually positioning their portfolios going into Monday's opening bell?
Well, the report's tactical tilt is three-pronged.
Okay.
First, they are staying overweight on big tech, specifically the AI infrastructure players, because that Tier 2 data center utilization proves the monetization is real.
The demand is actually there.
The demand is there. Second, they are remaining neutral on small caps, like the Russell 2000.
Why neutral?
Small caps carry a lot of floating rate debt, so they're waiting to see if these September rate cuts actually materialize to ease their borrowing costs before committing capital.
Ah, that makes sense.
And third, critically, they are tactically long on energy.
That long position in the energy sector via options on Exxon or ETFs like the XLE is functioning strictly as an insurance policy.
Exactly.
Because by holding energy, you are buying a direct hedge against that geopolitical tripwire in the Strait of Hormuz. If oil rockets to $95 and wrecks the broader market's rate cut euphoria, your tech stocks will take a hit, but your energy holdings will spike, acting as a counterbalance to protect your portfolio.
It is a masterful snapshot of the tension driving this market.
It really is.
I mean, understanding this dynamic, the tug-of-war between a cooling labor market giving the Fed permission to cut rates and the booming AI infrastructure sustaining corporate growth, It's the only way to contextualize the wild swings we are likely to see this week.
Yeah. But there is a deeper philosophical question embedded in this report, and it is something everyone should mull over as they prepare for the opening bell.
What's that?
We are observing a market that is pricing in absolute perfection. It is banking entirely on Jerome Powell executing a flawless, historically unprecedented transition to a 3.5% neutral rate without triggering a recession.
Right. A picture-perfect, textbook soft landing.
Exactly. A soft landing orchestrated by central bankers who only control the demand side of the economy. But as the survival of this entire bull market actually hinges on global energy bottlenecks in the Middle East staying perfectly under control.
Which is out of their hands.
That is a supply-side issue entirely outside the Federal Reserve's jurisdiction. The Fed can manipulate interest rates, but they cannot print barrels of oil, and they cannot deploy naval fleets to unblock shipping lanes.
So the question is, are we actually witnessing a masterful economic soft landing engineered by the Fed, or are we just flying completely blind in the fog of all-time highs, surviving purely on the luck that a geopolitical tripwire hasn't snapped yet? I mean, when you look at the VIX sitting near 12 while global shipping lanes are bottlenecked, it strongly suggests the market is ignoring the fog entirely.
An illusion of comfort indeed. Keep your eyes on those PCE numbers this Friday and watch how those energy hedges play out.